Welcome to Module 5, where we will be dealing with money. During this module, we will be covering the trust and business principles and how to go about distinguishing between the two. Basically, and in a nutshell, trust money is the client's money. That is, the client trusts you with it. And business money is the firm's money. Let's begin with trust money. Trust money is generally money handed to an attorney, which is held in trust and to be dealt with in terms of the client's instructions. These are usually advance deposits to cover fees and disbursements on a matter, for instance, divorce or criminal matters. These deposits are in respect of the work to be carried out by the attorney. Once the work is complete, the money held in trust will be transferred to the business bank account. Money is collected on behalf of a client, that is collections. Money is received from the counterpart attorney or opponents, where matters were successfully concluded, that is civil matters. Or money is received on conveyancing matters, where the attorney acts as the middleman between the bank and the buyer and the seller, and distributes the money accordingly. Money is received from or on behalf of a client as surety for a matter, whereafter the monies might be transferred to an investment Section 78 2A account. Business money, on the other hand, is the firm's money, and these are usually received from clients in respect of fees and disbursements, either deposited directly into the business account or by way of trust to business transfers, which is an income, less the business expenses paid, that is, salaries and rent, for example. Trust bank accounts and transactions. Trust banking accounts must be opened as a Section 78(1) account. Trust transactions will always be monies received on behalf of or from a client, or monies paid out to or on behalf of a client. All trust transactions must be clearly recorded and must be kept separate from business records. With regards to trust bank charges and interest, the interest on a trust account is not the firm's money, but needs to be paid over to the law society. The law society then uses these funds to pay any trust money which may have been stolen by an attorney back to the client. It works as insurance for the clients. They also use these funds to pay for training courses. The law society has agreed rates and charges with the main banks, and at the end of each month, the bank automatically pay the difference between the interest and the bank charges over to the law society. Trust money will under no circumstances be deposited in or credited to the business account, unless it is a trust to business transfer, providing that each such transfer covers the total amount due to it in respect of fees and disbursements raised. Business bank accounts and transactions. Business bank accounts can be a current or a savings account. All expenses incurred by the business must be paid from the business account only, and under no circumstances from the trust account. A firm is not allowed to pay any expense directly from the trust account. The money must be transferred from the trust account to the business account first, and then settled from the business account. If a client mistakenly pays his account into the business bank account, and the amount received exceeds the amount due, the balance, which will be in the credit of the client, must be transferred to the trust account immediately. As referred to earlier, no credit balance on a matter may remain in the business bank account. All credits must be held in the trust account. Trust to business transfers must be made from the trust account to the business account and not to any other account, for example, a practitioner's credit card. The interest earned, less the bank charges paid to the business account, is due to the firm and not the law society, like in the case of the trust interest. In conclusion, due to the fact that trust monies must be kept separate from other monies, the accounting records must be recorded in such a manner whereby it clearly distinguishes between trust and business transactions. Every client should have a matter business ledger and a matter trust ledger. We can now move on to petty cash. Remember, in every firm there will always be a need to purchase low-value items, such as tea, milk, cleaning or postages on a daily basis. And these items are usually purchased using cash. The petty cash book is used to record these items, and you need to record purchases as well as the source of the cash used for the purchases. The petty cash obtains its income from the cashing of a business check. This means that the firm cashes a check issued from the business bank account, and this cash is then kept within the petty cash box of the firm. When these smaller items need to be purchased, the person in charge of the petty cash, often the office administrator, will issue the cash to the person who is going to purchase the items. Remember, a receipt or cash slip must be kept for all purchases, and the total value of receipts must reconcile with the total remaining in petty cash. That brings us to the end of Module 5. Please complete your short assessment on the learning platform now.